You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for everyone's favorite educational program. Some may say the premier educational program for options traders. Yep, it's time for Options Bootcamp. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Hopefully you guys are enjoying the slew of content that is hitting you guys usually multiple times a day here from the network. If you're just subscribed, if you're just listening to Options Bootcamp, you're missing out on a whole bunch of other fun stuff. There's the Option Block twice a week, Vol Views every Friday, TWIFO every Thursday. Got the Advisors option sneaking in there, a bunch of other fun stuff. OPR, which is a program you guys would love here on Options Bootcamp, another education-oriented program. A lot of fun stuff hitting you guys, and a whole bunch more that I'm forgetting. Our interviews every Tuesday. So you got to tune in. You got to subscribe. Wherever you're listening to Options Bootcamp, upgrade yourself over to the full network. Get all those shows, the Crypto Rundown. I mean, you're missing a ton. So make sure, A, wherever you're listening to this, you've already subscribed, hopefully, to the full network. And B, if you like what you hear, keep those reviews coming in your platform of choice. Could be your Apple Podcast, your Google Podcast, the app stores on both of those platforms. You have an app, and a lot of you guys like to leave reviews there. You know, Podbean, wherever the heck you get the show, YouTube. Keep those reviews, those comments, those questions coming so new folks can discover the show. I should say, by the way, the questions, send them directly to us at Options on most of the major social media platforms. If you leave questions in like an Apple Podcast, something like that, probably not going to see it for a while. So if you have a timely question, hit us up via the other methods. We do love to hear from you guys. And joining me on the program today, my cohort, my partner in options educational crime, the author of one or two options-oriented tomes, and indeed the founder of Market Taker Mentoring, Mr. Dan Passarelli. Mr. P, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
Yeah, well, here I am now, so glad to be here.
There he is. All right, better late than never as we head on into our basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes,
sir. Ah, so festive. We love it. Of course, it is time for your basic training portion of the show. We break down a basic options concept, explore it in a little bit more detail. So you, the retail stock trader, maybe you're dipping your toes in options for the first time. Maybe you're ready to dive into the deep end of the pool. Either way, we can walk you through it. And, you know, we look to you guys sometimes to see what you guys want us to talk about. And you guys love our listener question paloozas. We've done quite a few of those. I'm sure we'll get to some of your questions a little bit later in the program. But we also asked you prior to our last series of episodes, what do you guys want us to talk about? And you guys overwhelmingly picked hedging crazy markets, 54.5%. So that was our topic from last show, even though I'm sure, given where we are in the marketplace right now, probably have to revisit that topic again. Probably got some questions about that front a little bit later as well. But your number 2 choice, with about 23%, was when to roll a covered call. So it seemed, Mr. P, like that was a suitable topic for today's show. Make the people happy. Do you concur, sir?
I love nothing more than making people happy, Mark. You know that about me.
That is your tagline, your mantra over there at Market Taker, is it not making people happy? Since 2008 or whenever the heck you guys set up shop over there in Market Taker land. Yeah, covered calls, obviously a very popular topic out there in the options world. If you guys search through our archives, you'll see a lot of episodes touching on various aspects of this strategy in the past. If you don't know what the heck it is, you probably should start there. Go back to the early days of the archives where we'll discuss this strategy in a lot more detail. Basic overview real quick right now, of course. Covered call involves owning the stock and selling a call against it, hence the term covered. You can also do it in a future with futures options and things like that. But for our purposes, we're going to keep it to the stock landscape here today. Let's kick it off here. Let's go with our basic example. What are we talking about when rolling a covered call? What the heck does that mean? Well, let's go back to our old friend XYZ. Everyone's made and lost fortunes in XYZ. Hopefully you're all on the latter tip these days. Let's say XYZ right around a nice even level. Let's say $100. XYZ is hovering at $100. You own XYZ in your hot little hands. And you say to yourself, I wouldn't mind selling this stock, perhaps, if it gets up to 110. So it rallies about 10% in the next month. That's a good run. And so I turn around. I'm going to sell the 110 strike covered call that expires in 1 month. And for the purposes of our example, keeping things nice and even, you get a nice, healthy, juicy $1 for that privilege. Now, let's say in our example, let's take it a little bit further. And throughout the course, this is the 1 month option. Let's say by week 3, this stock rallies exactly to 110. And it's hovering right at 110 or maybe at 109, threatening to break 110, right in that range. What should you do? That is the topic of conversation for today. So, Mr. P, let's start off there. Give us an overview, kind of your thoughts and your basic approach. Someone comes to you at MTM with this exact same scenario. I'm sure you get this question all the time. And they say, Mr. P, what should I do? What is your criteria? How do you like to set up when and when not to roll, sir?
So we have a system at Market Taker Mentoring. It's called the MTM Smart Income System, and it is very, very methodical. Covered calls are very, very simple to manage. And they have to be, because if you start injecting subjectivity into it, you're gonna run into big trouble. So here's how you do it. If you go with the concept, and by the way, guys, this is like a big core part of this class. You guys, being loyal listeners, are getting this complimentary, straight from the source here. This is what you do. When the stock goes up, you run the risk of it going through your strike price. And so really all your goal is, when the stock is going up and you have a covered call on, to fight to keep the profits on the stock. If you break even on the calls in the long run, like, you get out and you do a good job rolling and you make a little this time around, but you lose a little this time around. If just on average, you keep all your profits as the stock goes up on the stock and the call ends up just being a wash, fine. Then every time the stock goes down, you always outperform because you always lose less. And in the long run, you are going to outperform. So it becomes very, very simple. If the stock goes through the short strike price, you roll the darn thing, probably what we would call up and out, higher strike and out one expiration in time, no more than one expiration, but one expiration in time. And you just try and recoup enough to ideally break even on that call. But even if you lose a little bit, it's not the end of the world.
Yeah, one of the ways I like to approach this when I get this type of question, which I can imagine is very frequent, is, one of the easiest ways to handle this when should I roll, because you're right, Dan, the subjectivity portion of it is where people get into trouble, liking to keep these strategies nice and clear and objective and straightforward at the outset. So part of that is, of course, having a plan. at the outset of a trade. You could eliminate a lot of this hemming and hawing when it gets close to the strike if you have a plan going into it. So let's say, going back to our example here of the 110 strike you just sold for $1. If you did your analysis, you did your due diligence, I'm assuming you did, on XYZ, and you said, you know what, 10% is a heck of a good rally for this name. I don't mind letting the stock go at 110. That is the beginning of your analysis. If you're looking at covered call strikes, don't just look at them for income. Look at them through the lens of, am I comfortable letting the stock go there? And if not, maybe you consider a different strike. So if you come at it from that lens to begin with, to start with, that did a lot of your homework already for you. You already have a strike you are comfortable selling the stock at to begin with. So then, at that point, this whole other conversation becomes effectively moot. You've already decided you don't mind selling it at that level, and you can move on to another trade, kind of set it and forget it. Is that your approach at the outset, Dan, with your clients? You sit them down and say, okay, we really want to have a plan going into this, and then maybe if something changes, the roll equation comes into it? How do you approach that?
Yeah, I mean, that's like one of the first steps in the MTM Smart Income System is to know what your objectives are. And the objective to let the stock get called away and sell it, in this example, 10% higher, that is a noble objective. And it is a totally underused objective. That should, for most people I talk to, they get all upset if they get assigned, whether it's a cash secured put or a covered call. Oh no, this is terrible. That should literally be your objective probably about 2/3 of the time. You should want that to happen. That should be why you're doing this, not you're doing this in spite of that.
Yeah, that's one of the things that still mystifies me to this day, and I've been doing this for nearly 14 years now, at least on the radio side alone, going beyond that, obviously, a lot longer. People are still flummoxed. They're still angry when the stock gets to their strike and the stock gets called away. They don't realize if the stock gets called away, you win. That's what you're looking for in 99% of the time. You want to go to that strike. Let your stock get called away. You win. And yet it's mystifying to me. It's just a psychological thing people have. Oh, I'm missing out on all these other profits, or they have this psychological barrier. Maybe they think they were wrong in their initial analysis. Whatever it is, Dan, people can't seem to wrap their heads around it. If the stock gets to your strike and your underlying gets called away, you win. People just can't wrap their heads around that. They can't come to terms with that, Dan. They're not happy about it.
Yeah. And I will tell you what, it becomes so liberating once you open your mind to this fact, to this possibility. Oh, wait a minute. I got assigned. Oh, that's great. I met the objective I hoped to accomplish. This is great. And, the thing is, with any deal, and getting filled on a trade is like striking a deal, basically, right? It's kind of like if you're making any bargain and the other side accepts your bargain, you're like, oh, crap, I should ask for more, but no, the objective is to make a bargain that works for you, it is to make a trade. It's to get billed on your trade, or it is to get assigned,
Yeah, it's like the old adage of, I don't want to belong to any club that would have me for a member. People think that if it gets to their strike, they somehow were wrong. They missed out on something else, and there's all these profits they're leaving on the table. But yeah, that's what you want at the outset. So there you go. That alone could cover 80 to 90% of these scenarios we're talking about here. Set that objective to begin with. Utilize your covered calls as an exit point for your underlying, and you don't need to have this roll conversation. But let's say, for the other 10 or so percent, maybe a little bit more hardcore, maybe you have some sort of tax situation where you don't want to incur some capital gains. That certainly could cover. A lot of the asset managers out there come into that. Or maybe, let's say, in those rare scenarios, I hate to get into this because it leaves a little bit of wiggle room for people to kind of get out of their rules at the outset. But let's say something fundamentally has changed over the course of that 1 month period, and XYZ. The stock has exploded up 10% over the course of a few weeks. Maybe they acquired another company. Something else has materially changed to change your outlook on that trade. All right, now we're in a different scenario. Now we're in a position where either we can't sell the underlying, can't let it get called away, so we have to roll, or perhaps our outlook is different, and now we have a different price target on the underlying, and that old level of 110, it's not going to do it. Now we think it's 150 or 135 or something like that. So now we're in that scenario. We have to roll. What are we going to do? Well, as Dan mentioned, first off, the typical methodology. We had someone write in, I think, the other day talking about rolling back and up That is not the typical methodology. The typical methodology is going to be out and up. And so you're going to go out another month or two. Maybe you're in the weekly, so you got another couple of weeks. Maybe you're in the monthly, so you go out another month or two. But in general, you're going to go give yourself a little bit more time. And also, usually, because you're hitting your strike already, a little bit more room to run on the upside. So maybe in this case, we're going to go out another month. We're going to close out the 110 front month call that we sold there. Let's buy it back for whatever price, let's say in our example, 70 cents. Then we go on out to, let's say, maybe the 115 strike. 1 month out, so another month, so 2 months out effectively, 1 month beyond our contract we already have. And we say we're going to sell that, we'll say, again, for $1 in our scenario out there. So nice little juicy amounts. So you're net doing that spread for about 30 cents. Now you're giving yourself another month to play and another 5 handles of wiggle room to the upside. And in our example, you still got a little bit of premium to do it. So it's not a bad thing. But of course, Dan, there's a lot of different ways people look at how these rolls should be done. This is another question we get a lot on this topic. How should I gauge when to roll? Is it, for example, the changes in the premium? So in our example, we sold that XYZ call for $1. Now let's say the underlying starts rallying, and now that call is trading for, let's say, $2. Now it's doubled against you. It's in your face pretty much for 100%. It's doubled against you. Is that the criteria you should use, the change in the premium? Or other people like to look at how far away it is from your strike. For in this example, let's say once we get past 105, maybe we want to consider rolling within 5 handles of the strike. So there's a lot of different ways you could view your criteria for when to roll. In your very elaborate market taker smart income system, sir, what are the criteria you guys use? Is it the change in premium? Is it the distance to the strike? Is it something else entirely, blue moons? What do you guys use to judge when to roll, sir?
You know what? The simpler the method, the better always. Option trading can get real complex real fast, and sometimes it does, even if you're trying to keep it simple. So no need to get fancy until and unless you have to. So what we do is if the stock goes through the strike price, you roll it up and out. That simple. And let's say it does that right away, like you put it on today, it's a 2-week call, and by the end of the day, all of a sudden it's through the strike price. So you're like, wow, I didn't see that coming. I sold the call for $1. Now it's trading at $2. Okay, no big deal, man. Because if it's higher and you end up selling a yet higher strike with another week out, and you can bring in, even if you can bring in $1, if it gets to that strike and doesn't get assigned, then great, or if it doesn't get assigned at all, you're bringing in that $1 that you lost, and you get to keep everything you made on that stock. It meets your goal. So never, ever, ever be afraid of losing on the short call portion of a covered call. That's all part of a system, and it's not a concession. It's not like the bad part. It's just part. It's it's one of these cogs in the wheel that is not bad or good. It's something that it's one part of the system that makes this whole money-making system work.
You touched on a lot of points that I want to get to there. So well done there for you, sir. But you're right. I think that's a smart way to do it. I think keeping it simple. People who tend to focus on the changes in premium, that can get obviously very subjective. It's obviously also going to change the closer you get to expiration. You're going to have a lot more gamma, a lot more theta kicking in there. So that premium is going to move all over the place. So doing it on a premium basis is a bit of a moving target and a little bit of a challenging thing. Strikes are not going to change. That's the one thing you can count on. That 115 strike, barring some sort of weird corporate action or a split or something, it's always going to be that 115 strike for the lifespan of your option, or in our case, the 110 strike. So that's something you can rely on. It's a fixed goalpost. You know how close you are to it. You know what's going to happen. So that's definitely my preferred criteria as well. Distance to the strike, it should be the way you're playing this game. But you also touched on something else I wanted to get to, Dan, which is kind of fascinating. The analogy I always make is you go to Vegas. Let's say for some reason you're going to Vegas for a week. You really like Vegas. I prefer maybe a day or two, but a week. You can do a week, let's say. So you get there, you land from the airport. It's your first roll of the dice at craps, your first hand of blackjack, whatever it is, and you win huge. You win like 10 grand or 100 grand, something absurd. It's almost like a worst case scenario because you just won all this money and now you still have the entirety of your trip for it to happen. And the smart thing is you should walk away, but you also know you're there for a week. What else are you going to do? So that's the analogy I often make when people hit it big in these trades early. And that's a problem we see with covered calls as well. When the stock goes your way very quickly, like let's say in our example, you put on the 1 month covered call, and on day 2, bam, it's at the 110 strike. Now we see people starting to hesitate a little bit as well, Dan. They're, for whatever reason, a little bit more reticent to roll when that option still has a lot more lifespan to go versus right at the end of an option's life. Obviously, if you're close to expiration, the probability of that option expiring now in the money is a lot higher, so you can take that off knowing you're avoiding an assignment of having your stock getting taken away. Whereas earlier in the option's life, you might say, hey, I got some time. This thing could drop back down. This delta is still kind of fluid, and want to play with it that way. Do you, A, encounter that with your clients? Are they a little bit more reticent to roll in the early period? And if so, B, what do you tell them in those scenarios, sir?
I don't know. Just to go higher level here, a little bit more general. I would say that because your objective is established while you're thinking about making the trade, and then your plan is set while you're making the trade, there ends up being nothing to think about. Me, like everybody else who's ever traded anything ever, when you first start trading and you have a losing trade, you're like, oh, God darn it, this stinks. Oh, man. Oh, and, you're having a bad day or whatever. Man, now, especially with covered calls, I don't care if I lose a little bit of money on the call. And it's not like I'm being willy-nilly. I knew what my objective is. I know what my plan is. That was one of the things that is part of my plan. And so I do my role and I move on. And that's it. I don't care if it happens today. I don't care if it happens the day before. I could potentially work some of that into my plan if I want to make it a little bit more complex, which could be okay. But, there's no emotion involved. There's no thought involved. I've already thought it out. I'm just following along with it, if you start a business, you don't open a restaurant and hey, today's the grand opening. People are coming in. What do you guys think we should sell? Burgers? How about tacos? No, maybe steaks. No, you write the business plan and then you open the restaurant and you're ready to go. You just follow the plan.
Look at you with the apt analogies, sir. You put your training hat on today. Well done. But you're right. Now, these are things you could and should consider at the outset of your trade. And so if it approaches your strike, regardless of when that is, once it hits your strike or crosses it, in the cases of Dan's system, a lot of people like to go that way as well. You roll it. Doesn't matter what time frame it is. If it's on day 1, or if it's on the final day of that option's life, you do your roll. These are the non-subjective elements we're putting in there. These are the objective criteria, objective rules you're establishing at the outset of your trade. So you don't have to have this wishy-washy, should I roll it right now? No, you know the answer. It's already built into your system. Speaking of building it into your system, let's fudge a little bit, Dan. Let's say I'm doing a covered call, but maybe I want to leave myself a little bit of wiggle room at the outset. Maybe I say, I want to go back to my example, XYZ is at 100. I want to sell that 110 call. I don't mind dumping it at that range. I'll take that buck. But you know what? If it blows past 115 in this time frame, maybe my outlook has changed. Maybe something has materially changed with this underlying. So I'm going to come back and I'm going to buy that 115 call as well. In this case, I'm going to do it for 50 cents. So now, instead of just selling that 110 covered call, I've sold that 110, 115 vertical for effectively 50 cents. And so what have you done? Obviously, the obvious step is you reduce your outlay by about 50%, but also you've effectively baked a roll into that trade, because now if the underlying continues past 115, guess what? You're playing again. And so you don't have to do the roll because you already have it baked in at the outset. Dan, what are your thoughts on using verticals instead of straight up covered calls by themselves, and maybe as a bit of a backdoor way into baking in the roll at the outset? Are you a fan of that strategy, or is that not make the grade in the MTM system, sir?
No, I don't see the point there. I feel like that's fancy for no reason. The only reason you would do a vertical, and you're talking about credit spread vertical, right?
Hopefully. Otherwise, you're doing it wrong.
Yeah, you're doing it real wrong. But I mean, the only reason you would ever even thinking about doing that is because you're afraid of like a gigantic blow through your strike and you want to limit the loss on the short call, which I've already made the case for saying I don't think you should want to do that anyway. But I mean, if you are that worried about like a gigantic move to the upside, you shouldn't be doing a darn covered call anyway. Like my covered call or recycle trade this year was like I was largely in cash, coincidentally, like shortly before the pandemic happened. Started writing cash secured puts on the way down. Don't get me wrong. It's not like I called the bottom and, it was the perfect play, but it was a good play. It worked out real nice. Sold cash secured puts, got assigned, sold more cash secured puts at a lower strike, got assigned, sold more cash secured. And so I scaled back into what I was out of reasonably well. And then, you get to that violent bottom and you see it kind of going back up. And I'm like, there is no freaking way in heck I'm going to start selling calls on this now. That would be absurd, because I think there could be room to really take off to the upside. Nobody knew it was going to happen. I didn't either, but it seemed the most likely scenario after 27 years of doing this, And so like I waited because I thought there was a pretty good chance we could blow through some strike prices. So I waited until the market retraced probably 2/3 of its move. I think the first strike I sold was the 300 strike, if I'm not mistaken. And then it did. And then we went into this game that we're talking about now. Okay. Went through 300, got assigned, roll up to a higher strike, blah, 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 So, yeah, I mean, I hesitated and I pulled out of the smart income system, waited for the market to rally hard, which it did, and then started selling calls. Like doing a credit spread would have just been like, how would that have possibly helped me? Like, not at all.
This recent meltdown has been an eye-opener for a lot of people here, and certainly maybe has impacted your covered call trading. But let's review here what we've talked about on the episode today. So your covered call, your basic covered call. You own the stock, you sell typically an out-of-the-money call against it. If it's an at-the-money call, you're going for more juice. That's almost a different conversation. You better be ready to roll or let it go away if you're selling at-the-money calls. You need to have that in place if you're selling at-the-money calls. But you should have this plan in place at the outset for any covered call trade. You need to know what you're going to do at the outset. Typically, the analysis is, I found a strike where I am willing to sell the underlying, and I have written said call on said strike, and I am happy with the consequences. And that should cover 80+% of you out there. Don't start getting mealy-mouthed on me and say, oh, it's getting close to my strike. I really want to change. Maybe I want to buy that back now. You should establish that at the outset and have some faith in your analysis. Have some faith in yourself. Let your stock go away. You win in that scenario if your stock gets called away. Now, for the small percentage of you, and it should be a small percentage of you, who can't, for tax reasons, let your stock get called away, in which case you should let that bake into your covered call strikes. You probably want to sell a little bit farther out of the money and not have to worry about having tax issues to begin with. Or maybe in those rare scenarios, and I hate even saying this, like I said, because this gives you an out, gives you some wiggle room, but your fundamental viewpoint of that stock has changed now as a result. So in that small percentage of scenarios, when should you roll? We both agree, Dan and I, that you should do it when you pretty much use your strike, first off, as your main criteria, not changes in premium. That gets very vague, that gets subjective and wishy-washy, and it's a moving target. You don't want a moving target. You want a fixed goalpost, in which case you fixate on the strike. So once it hits your strike, that's your cue to roll. How do you roll? You typically roll up and out. There's no hard and fast. If you're out 5%, you should roll 7.5%. Everyone's covered call is a little bit different. Some people like 2% out of the money call. Some people like 5%, or in our case, we did a 10% out of the money call. That's all subjective. We can't tell you how you should set up your covered call. We can't tell you what percentage out of the money you should do, because every underlying is different, every skew is different. But once you have that in place, you should roll up and out, usually 1 month or one cycle. Rolling for a week, I'm not a huge fan of, because that's just going to get a lot of busy work for you. But if you're doing it in the monthlies, then roll another month out usually is a pretty good time frame. And doing verticals, both of us not huge fans of doing it, even though that does bake in the roll at the outset. So if you're, for some reason, you are a little bit concerned about explosion to the upside, then a vertical could be a strategy to consider. But then, as Dan pointed out, you may want to think, is it really worth selling covered call if I expect this explosion to the upside? Maybe you want to consider something else there instead. Dan, any other nuggets you want to share on rolling covered calls before we get a couple of listeners on the program, sir?
Man, we covered like such important things. This was a really great discussion, I thought. And just keep it very, very simple, and know your objective, know your plan, follow your plan, and it frickin' works, man.
It freaking works. That's our takeaway from this episode. Now it's time to see what you guys have on the brain with a little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
You guys are always asking for more boot camp, want meatier episodes. Here you go. Getting a little bit meatier episode out there today. Let's kick it off. Actually, our number 3 topic that you guys chose, actually number 4. It was number 4. Listener questions was higher. But number 4 on our poll of topics for the show, you guys chose impact of the SOFTBANK whale. And that actually dovetails pretty nicely here with our first question. This comes from Elsewhere. I kind of like that handle. With a Z. Elsewhere with a Z. They say, is it true that this whale from SoftBank, they put SoftBank with an E, but SoftBank pretty much drove up the market? Oh, and if you hear that, sounds like they're doing a little bit of construction here in the building outside our studio. So if you hear some drilling outside, when our walls aren't collapsing, there's just a little bit of work being done around here. I assure you, we are safe and sound here in the Options Insider Studios. And this is an interesting topic. It's been kind of the topic du jour in the world of options for the past couple of months after this report came out, that this division of SoftBank effectively came out and started gobbling up calls in the latter portion of the year. Particularly, it seemed like around August. In fact, we have their 13 Fs now. And it looks like going into the end of Q2, I think this 13 F is through Q2, they had no options whatsoever, but they had huge underlying holdings, over $1 billion worth of Amazon. That was their largest holding, and about half that, about $500 million for Alphabet. Then it kind of falls off from there, about $250 million for Adobe, Netflix right behind it. So they had a lot of tech stocks, a lot of tech underlying in their portfolio going into the end of Q2. But it seems like they really started loading up on the calls in August. This has been an interesting point of contention with me and some of our contributors on the network, as well as some of our listeners as well, because a lot of the initial blush of coverage on this was, hey, it looks like they're getting super bullish and they're driving up all these underlyings as a result. I've always been more of the opposite tip, that it looks to me like this might have been a bit of a stock replacement. It certainly would make sense if you got $1 billion worth of Amazon that you're sitting on. Maybe if you're worried about some lofty valuations, you take some of that off the table and you swap it out with calls to effectively give yourself a little bit of a downside cushion. Now you're taking the lion's share of your equity and your exposure off the table, and now you're only participating to the upside, and if it drops, you're very limited on the downside. That makes a lot of sense to me. We haven't really seen the final analysis yet of what exactly they may have been up to. That should be coming out pretty soon. But that's kind of where I'm leaning. Dan, have you given this any thought, and have a lot of your clientele been asking you about this SoftBank guy? And what are your thoughts on whether this guy contributed to the massive run-up we saw in August, sir?
Yeah, I mean, that's the old tail wagging the dog theory. I mean, there is a tiny little, look, I don't know what the SoftBank guy was doing, and neither does anybody else listening to this show, unless you know the guy and he whispered it into your ear, So, it's kind of silly speculation. But, just talking, in general, is there anything to the tail wagging the dog theory that if somebody buys a metric crap ton of calls that it can drive the stock price up? I mean, there is a little bit because if somebody buys a lot of calls, then market makers are selling a lot of calls and they hedge delta neutral, which forces them to buy the stock, which can force the stock up higher. So, I mean, I don't know, but then what happens at expiration, right? Because if the options expire, the stock that the market makers bought, they don't need anymore, and it has to be sold. I mean, the delta would ultimately get smaller as each day passes, so they would sell off that stock, probably not all on expiration day, but leading up to it. If it's all in the money, then the stock gets assigned and they sell the stock too. So I don't know. I mean, especially if those were August expirations, I think that's what you said, Mark. I mean, we would have saw a pretty good retracement, I guess, right? So I don't know, like you've got to be an expert to use unusual activity, I think. Mark, I think you've got a whole show on it, and there's some really, really smart people out there who do work within that. But like just saying, oh, look, a bunch of calls traded, the stock's going to go up, like there's not enough information there to derive any information you can trade on.
I think the impact of this, if it was, as they said, it was short-lived, because you're right. The market makers, if they're selling a bunch of calls, and if someone came in and just bought a boatload, let's say, of August calls and Amazon and Alphabet and all these things, then the initial blush would be probably a little bit of a rally in the underlying, because the market makers have to hedge that. Remember, they're selling calls, so they're getting short delta against you. They have to turn around and buy those deltas back. They don't want to have delta exposure. They want to hedge that out. They want to be what's called delta neutral. So they're going to buy back that stock. So in the near term, that could give a little bit of a lift to these underlyings. But, as Dan pointed out, it sounds like they're supposed to be monthlies, in which case that's an interesting thing. Do you roll it, going back to our earlier conversation from our basic training, or is there something else going on? And also, I think that's a very short-lived effect, that they can hedge out those deltas and have some other things going on. So I don't think you're going to see the perpetual rally throughout the month of August that people have been laying at the feet of this SoftBank whale. But it is an interesting topic, and I think one we want to sink our teeth into a little more once we have a little bit more data. But it looks to me, it smells, and it seems like a stock substitution. What do you guys think? Hit us up. Let us know. This was an interesting one. We kind of touched on this on another show, Dan, but it was a pretty popular hot topic, and I wanted to get your thoughts on it as well. This comes from Ed. Ed wants to know, I think we might see a return of the mini options with so many popular tech stocks, aside from Apple and Tesla, trading at astronomical prices that are beyond the reach of most retail traders. This is an interesting question. Of course, we have, Apple and Tesla very famously split not too long ago, but there still are a lot of names. Amazon, Alphabet, all these names out there that are still at astronomical price levels and that are exorbitant and perhaps onerous for a retail customer to come in and even trade a one lot in. And this was the exact situation we found ourselves in a few years back when the minis came and more infamously went the last time. But it does seem like, Dan, maybe we are setting up for another interesting scenario for the return of the minis. What are your thoughts on this, A? And B, have you heard any similar inquiries from your mentees over there at MTM? Do they want a little bit of a smaller contract?
I haven't heard many rumbles about that from our flock over here, from our community. But I don't know. Like, you can look at this from a couple different perspectives. One is volumes have been up greatly in option trading this year because they all went corporate. I know at least one of the exchanges had a whole bunch of job cuts over the last couple of years. And so these exchanges are making a lot more money. And so they've got room to try out different, expand their product offerings somewhat. That said, it didn't work the first time, so why is it going to work the second time? That said, I wonder if some of these stocks might split, especially after seeing the run up in Apple when they announced the stock split and when it happened. So I don't know. I would assign like a 10 delta to seeing mini options make a comeback.
I'd be interested to see it. Hopefully it'd be a much better implementation than last time. Last time, kind of the entire industry fell on its face with this one. The brokers tried to charge full freight for a 1/10 size contract. Customers are not idiots. They saw through that pretty quickly, so didn't want to pay full freight. So that hurt them. The exchanges charged full exchange fees for these things. Market makers were a little bit dubious of them, so they kept their markets wide. Everyone kind of dropped the ball in the chain there in the industry. And as a result, the products went the way of the dodo. So hopefully if they did bring them back, they would have a much better implementation. A, and B, the downside of that is, of course, they are subject to a split. Of course, Amazon, some of these stock prices, even if they split, are still exorbitantly expensive. So maybe not as much of a risk as it would have been. But still, it would be interesting to see, A, if they come back, because there probably is a demand, and then a different environment, too, with most brokers charging less commissions and no ticket charges. Maybe a little bit different environment for that might make it a little bit more friendly. So I would be interested to see them make a comeback if they're implemented correctly. And then we could see, maybe get a little bit more action back. Of course, they're doing a lot of paper as it is. It doesn't seem to be hurting Apple and Tesla. Apple's doing almost 1 million shares of contracts a day. Tesla getting close to that, and they're post-split. So I guess it doesn't seem to be hurting them, but it might be helpful for some of the retail folks out there, particularly listeners of a show like this, to have a little bit smaller contract. All right, Dan, we'll wrap it up with some love. A nice, easy one for you here. This comes from Takedown. Takedown says, can Dan give a quick overview of his books, please, and are they suitable for beginners? Dan, I've always joked you are the author of a handful of options-adjacent tomes, but for our listener, Takedown here, and everyone else who wants to know, A, what are your books about? And then B, as he asks, are they suitable for beginners, sir?
Yeah, I mean, I was part of a handful of books where I had a chapter or had, sections where I was quoted or whatever. But I wrote 2 books on my own: Trading Option Greeks and The Market Taker's Edge. And Trading Option Greeks is exactly what it sounds like. It's kind of, it's been called the Bible of the Greeks, which is very nice of whoever it was that said that. Maybe it was Mark. I don't know. But that's all on the Greeks, and it's everything that you need to know about the Greeks. And whether you're new, advanced, or whatever, I believe that that's a very important book to read. I spent a lot of time thinking about what's right and a lot of time writing it so that it would be really all-encompassing, give you everything you need to know. And the other one, The Market Taker's Edge, is sort of a professional trader's perspective for the non-professional. And if you're a super beginner, I would start with Trading Option Greeks. A few things might be advanced, but we actually have a free section to our website. Mark, you mind if I tell the people about this?
Have at it. Go for it, sir.
Yeah, we've got a free section to our website that has some really basic trainings. And if you just go to markettaker.com and click on the button that says join free, start there. There's a simple 8 or 10 video pack there. They're all nice short videos. Watch those first, and I think the book will make a whole ton of sense to you then.
All right. Unfortunately, listeners, that music means we've come to the end of this extra meaty episode of Options Bootcamp. Hopefully you guys enjoyed it. Dan already laid it out for you if you want to learn more, maybe about his books or, of course, about his courses or everything else. Market Taker 2Ts is the place to go.com. Click on the members tab, and you're off to the races. A brand spanking new website. Check it out. He's been working on it for, I think, over a decade now. So check it out for yourself over there. Kick the tires and light the fires. And give his books a check out over there on the old Amazon as well. He's Passarelli's 2 S's and 2 L's. Passarelli. If you're looking for him over there. And, of course, if you like what you hear on this show or on an entire network, make sure you keep those reviews coming. We see an influx of new people pretty much every day out there in these troubled times. It's more important than ever, so keep the people coming. If you like what you hear, share it out there with your friends and family. Leave the reviews on your platforms of choice so new folks can discover this program. And we'll see you back here throughout the rest of the week. Education Wednesday also has Options Playbook Radio. You guys will like that one if you haven't checked it out as well. You have the Option Block and TWIFO on Thursday, Volatility Views on Friday, and a whole bunch more throughout the week, all the way through to the next Education Wednesday and another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.